The high yield space appears to be really expensive with spreads around 260 to 270, which looks to be at all-time lows. However, if you look at the composition of the market, you see a market that's really still pretty healthy. The index itself has 54% of double Bs, which is the highest it's ever been, indicating its security. And it's the most secured market of all time at 34% being secured bonds. Additionally, default rates seem to be at moderate levels around 3.5%. And you have a net leverage ratio of 3x for most of those issuers. So the market remains pretty safe despite what appears to be a very tight credit spread. Given where baseline rates are too, you still get an all-in return that's pretty attractive relative to the prior couple years. I think one of the limitations in the high yield market right now is the presence or threat of tariffs in the United States. We don't know how those tariffs will impact companies' leverage, potential to generate cash flow. And specifically not knowing what Trump might do with certain industries, it poses for a real tail risk that could impact the fundamentals of the high yield market. Right now you're seeing an emergence of private credit. Private credit AUM in the US has doubled over the last 6 years, so it's now around $1 trillion in AUM. That includes dry powder, but when you compare that to the high yield market, which is 1.4 trillion, and then the leveraged loan market, which is another 1.4 trillion, you're seeing increased competition within these markets. So issuers that would historically go to the public markets are now looking at private credit as an alternative option to finance their business. As a result, you're seeing these spread compressions between private credit and the high yield public markets really compress. So in 2017, private credit offered yields that was almost 400, 500 basis points above the public market, and now that difference has converged to around 100 basis points, indicating the increase in that competition.